You didn't vote for him, but he has more power over your life than the president. Meet the new federal. This is Kevin Warsh, and his arrival at the Federal Reserve is about to send a shockwave through your bank account. For years, we've been used to easy money, but the Warsh era is built on a very different philosophy. He is what Wall Street calls a hawk. That means he hates inflation more than he loves your low mortgage rates. If you're waiting for rates to drop before buying a home, Warsh might be your worst nightmare. To understand Warsh, you have to understand the battle between hard money and the printing press. For a decade, the Fed has kept rates low, effectively printing wealth into existence. But Warsh thinks that's a trap. He believes that artificial growth leads to real pain. His solution? A controlled burn of the economy to kill inflation. This means your credit card debt, your car loan, and your business expansion just got a lot more expensive. But there's a silver lining. For savers, the Warsh era could mean the return of real yields, money that actually grows. So, is he a villain or a savior? The answer depends entirely on which side of the debt ledger you're on. Here is the secret weapon Warsh believes will save the economy: productivity. Specifically, the AI revolution of 2026. He argues that if AI makes us efficient enough, the economy can grow at 6% or more without triggering a single spark of inflation. It's a bold bet. He's telling the world, if the printing press stays quiet, the robots can do the heavy lifting. This is why the markets went wild when he was nominated. Gold crashed, and the dollar surged to a 4-year high. Investors aren't just betting on a man. They're betting on a future where growth doesn't mean expensive. But there's a catch. To get there, Warsh has to dismantle the Fed's $7 trillion safety net. And that's where things get dangerous. The conflict: Warsh wants to cut the printing press, but the White House wants lower mortgage rates. You can't easily have both. See, the Fed's $6 trillion portfolio of bonds is what keeps long-term rates, like your home loan, artificially low. If Warsh starts selling those bonds to shrink the Fed, he's effectively pulling the rug out from under the housing market. This is the Warsh Paradox. He might lower the cost of a car loan while making your dream home twice as expensive to finance. Market insiders are calling this the death of the 3% mortgage. In a Warsh Fed, those days are likely gone forever. So why would he do it? Because he believes a leaner Fed is the only way to prevent a total currency collapse in 2027. The deep conflict. For years, the Fed has been the silent partner in America's massive $34 trillion debt. Warsh is proposing a new accord. He wants to stop the Fed from buying government bonds just to keep the deficit manageable. If the Fed steps back, the government will have to pay market rates to borrow money. And those rates could be staggering. This is a direct challenge to the Treasury. It's a fight over who actually controls the value of your dollar. Some call it financial discipline. Others call it a debt trap that could trigger a global liquidity crisis. If the government can't borrow cheaply, they only have two choices: cut spending or raise your taxes. The strategy: in a Warsh-led economy, the old safety play is changing. Gold and silver are no longer the automatic winners. Since his nomination, gold has plunged from all-time highs as the market bets on a stronger, hard money dollar. Instead, capital is rotating into productivity tech, the companies building the physical backbone of the AI revolution. Think semiconductors, energy infrastructure, and data center giants. These are the Warsh winners. Small cap stocks are also seeing a catch-up trade as they look forward to lower short-term borrowing costs. This isn't just a market shift, it's a regime change. You need to follow the productivity trail. The reality check: if you're holding Bitcoin, the Warsh era just handed you a $60,000 wake-up call. He calls Bitcoin cool software, but his policy of rate cuts without QE is a liquidity nightmare for crypto. Without the Fed printing trillions, Bitcoin loses its fuel. It's no longer about a moon mission, it's about survival. The final verdict: Kevin Warsh isn't here to be a friend to the markets. He's here to be a doctor for the dollar. The transition will be painful. Mortgages will stay high, crypto will stay volatile, and the debt battle is just beginning. But for those who understand the productivity play, 2026 isn't a crisis, It's the greatest entry point in a decade. Stay tuned to Penny Pulse as we track every move of the new Federal. Subscribe now and don't get left behind.